Did you know that homeowners can convert the equity they've built up in their homes into lifetime income? In this video, I'll show you how professional financial planners help their clients structure these conversions. I'll also walk you through all of the tax calculations we'll need to consider along the way, along with how you can take advantage of almost $500,000 in tax exclusions. Let's dive in. If you own your home and you have equity in your home, you can transfer the value stored in the home into an income stream. Now, the key here is that you have built up equity in your home. So this is by no means a get quick by flipping a home scheme. And for those of you who don't already know, equity is like profit. I want you to think about it this way. If you sold your house today and paid the realtor, your mortgage lender, your stager, and all the applicable taxes and fees, what are you left with? This amount, less the amount you will spend on your new downsized home, is what you can tap into to create a lifetime income stream. This strategy I'm going to share with you is a proven method to produce lifetime income from home equity. It'll involve selling your existing primary residence and downsizing into a home that is cheaper than the house you currently live in. The key here is to make sure that there is enough of a difference or cash left over to invest. Now, this is critical because the difference between the proceeds and the purchase price of your new home is going to be the capital or the principal that you're going to put into your brokerage account. We're going to talk about how that money will be invested later on in this video. Now, if you own a primary residence that is a multifamily unit like a duplex or a building with an accessory dwelling unit or something like that, landlords might have to make other considerations like needing to incentivize their existing tenants to leave the rental. There are tenant protection considerations, and we don't have time to just go into that right now, but stay tuned. Which is a great segue for me to ask you to like and subscribe and turn on notifications so that you'll know when new videos are added to my channel. Okay, so I've broken down the process into 12 steps. Don't worry, this is not a recovery program. This is a instructional video on how to sell a house. This is a big transaction. There are a lot of moving parts. It's probably one of the biggest anyone would ever make in their lives, so I cannot stress enough the importance of running your specific scenario by a certified financial planner and a tax planning professional like a certified public accountant. And again, what I share here is for educational purposes only and not meant to be taken as specific advice for your situation. All right, so step one, figure out how much your house is worth. What is your home's fair market value? You can do this by contacting a local real estate agent. You can ask your friends and family for a referral to someone that they trust to give you a ballpark estimate. Here's a pro tip. Use the lower end of the real estate agent's estimates in your calculations. Some realtors like to inflate the possible final sale amount to entice you to list your property with them, so keep that in mind. Alternatively, you can use websites like Redfin or Zillow to give you an idea of what your house might be worth on the open market. I would go with some blend of your own research and the professional advice you receive from your real estate agent, or just use the most conservative numbers you can find. Now, there's no way to know with exactness what the final sale price will be until you actually sell the house, so the numbers don't have to be exact, but the number we do use needs to be realistic. So make sure you use a number that is a really great realistic estimate of your home's value and not the sales price you want it to go for. Step two, ask your realtor how much of a commission they will charge you to sell your home. Now, this is typically expressed as a percentage, and this is typically around 6 or 5%. Another pro tip here is to ask your realtor if you would get a discount on the commission if your realtor represents both sides of the sale, meaning that your realtor is also acting as your buyer's realtor. In some cases, this could knock off a percentage point off the commission. Okay, I'm going to start introducing some information about our hypothetical retired couple in San Francisco. In their story, their realtor is charging 6% and their home's estimated fair market value is $2.2 million. On a $2.2 million home, the sales commission would be $132,000 if the sales commission is at 6%. Step three, calculate your transfer fee. San Francisco homeowners are subject to a transfer fee when they sell their homes. If this isn't a thing where you live, you can skip to the next step. But essentially, San Francisco has a tiered system for calculating transfer taxes. In our hypothetical scenario, the $2.2 million home lands in the $1 million or more or less than $5 million tier. This means that the sellers will need to pay $3.75 for each $500 or portion thereof of the final sale amount. For our case, the sellers will need to divide 3.75 divided by 500, which equals 0.0075. Now, we're going to multiply their home's fair market value of 2.2 million by 0.0075, and that gives us 16,500. Okay, step 4. Calculate what it will cost you to get the home staged and ready for sale. I spoke with a longtime realtor of high-end real estate in San Francisco, and he suggested that I use 3% of the home's value as a good rule of thumb to determine a budget for cosmetic updates and staging before the house can go on sale. In our example, with our $2.2 million home, this comes out to $66,000. But to make things easy, I'm gonna say that the couple spent $50,000 on cosmetic updates to get the home ready for sale, and that they also spent $12,000 on staging. And for those who don't know, a stager or stagers are professional folks that come in and take all of your belongings out of your home and bring in new furniture and furnishings to showcase your home's best assets while minimizing its deficiencies so that it will show better to prospective purchasers. Step 5, calculate your home's basis. In other words, the value of the home when you originally purchased it, plus any updates you've done to improve the property. If the improvement is something attached to the structure, then it's probably something you can include to increase your home's basis. This is important to know because you will need to know your basis to calculate federal and state capital gains taxes. Some examples are new kitchen cabinets, new tile work in the bathroom, a new roof, a new HVAC system, new electrical. All of those updates can be rolled into your basis calculation. You're going to want to have proof of all of these updates in the form of invoices and receipts so you can substantiate them in the off chance that you are audited by the IRS. If you have any questions about which updates can be added to your basis, consult your tax professional for specific advice. Step 6. The Section 121 exclusion allows single-filer homeowners to exclude $250,000 in capital gains from their taxes. And if you are married and you're a homeowner and you're filing jointly, you both get to exclude in total $500,000 in capital gains. In general, to qualify for the 121 exclusion, you must meet both the ownership test and the use test. In general, to qualify for the Section 121 exclusion, you must meet both the ownership test and the use test. Here's a little bit more about eligibility.
You're eligible for the exclusion if you have owned and used your home as your main home for a period aggregating at least 2 years of the 5 years prior to its date of sale. You can meet the ownership and use tests during 2 different periods. However, you must meet both tests during the 5-year period ending in the date of sale. Generally, you're not eligible for the exclusion if you've excluded the gain from the sale of another home during the 2-year period prior to the sale of your home. Refer to publication 523 for complete eligibility requirements, limitations on the exclusion amount, and exceptions to the 2-year rule.
In our example, let's say the homeowners are married and meet the requirements to exclude $500,000 in capital gains. This means that after the couple has subtracted commissions, basis, and exclusions from their expected sales price, they are left with their taxable amount. Step 7, figure out how much you're going to owe the federal government in capital gains tax. So I want you to grab your previous year's tax return, it's also known as your Form 1040, and take a look at line 15. This line will give you your taxable income from the year prior. You're going to use this number to find what your capital gains tax rate will be. If you search for capital gains tax rate and the year of the transaction, you'll likely find a list of income brackets and a corresponding capital gains rate. Now, most folks in a typical year when they're not selling a house in California will most likely fall into the 15% capital gains tax rate. Now, typically this client will be in the 15% tax rate, but because this transaction is going to increase their income for the year, they get pushed into the 20% capital gains tax rate. And on top of that, they're gonna have to add on what's called the net investment income tax. And that's an additional 3.8%, which I'll go into in a little bit. In step 8, now in this step, we repeat the process of step 7, but we use California's state capital gains tax tables. Side note, in California, there is no distinction between between capital gains income and earned income tax rates. So the same tax table they would use to calculate their income tax will be the same table that they will use to calculate their capital gains rate. Now, in our example, our couple typically falls in the 9.3% capital gains tax rate, but in this transaction, they're pushed into the 11.3% tax rate. So luckily, California conforms to the IRS Section 121 exclusion, meaning that you can exclude the same $500,000 we did for federal capital gains. So again, take the taxable amount net of your capital gains exclusions that you calculated in your previous step and multiply that by 0.113. Step 9, determine all of the payoff amounts. Figure out how much you still owe on your mortgage. You can find out your mortgage payoff amount by either looking at your monthly statement or by calling the lender and asking them for a payoff amount. If you have a home equity line of credit with a balance or a home equity loan, you'll also want to find out the payoff amounts. Add up all of these amounts and label this as your debt to pay off. Step 10. Let's first calculate our total tax liability because this will need to be paid by the filing of the next tax return after the sale of the home. We're going to take this amount and set it aside in a high yield savings account and keep it in cash until it is time to pay capital gains taxes. Step 11, determine what is left over after paying for the sales commission, staging, updating, and paying off taxes. This amount leaves you with your profit net of expenses and taxes. This determines your budget for home shopping and for investing. And it's important to note here that the less you spend on your new house, the more you're able to put into your brokerage account, which in turn enhances your lifetime income. Step 12, you can buy your house with cash or you might qualify for a mortgage. It depends on your other provable sources of income when it comes time to purchase your new home. In our scenario, let's say that the couple decides that they are attracted to less home maintenance, and so they are very much attracted to a condominium community. They end up buying a 3-bedroom, 3-bath condo with a golf course in the vicinity, and the condo is $750,000. Now they want to use the cash from the sale of their San Francisco house to buy their Palm Springs home. Maybe in a low interest rate environment, one could argue that this couple could leverage their cash and take on a cheap mortgage. But these clients like the idea of having no monthly mortgage and the security of knowing that they own their home outright. Step 13. I think I said Step 13, surprise, there's an extra one, I guess. Set aside 1 year of monthly living expenses and invest the rest. To determine your monthly living expenses in your new situation, you're gonna sit down and make a list of all of your expenses in your existing situation. This is probably gonna be found on your budget, and maybe you don't have one already, but maybe put one together so you can have this information. Now you're gonna compare that with the expenses from your new situation. Now you're gonna wanna take into consideration things like your homeowners association fees, and in special circumstances, a land lease fee, which is a unique characteristic of some property in the Coachella Valley. Okay, so you take the rest of the cash and you put it in your brokerage account. Another tangent. Ideally, this account is a trust account, and there are many benefits to taking this estate planning step that I'll touch on in more detail in another video. Step 14. Oh my gosh, they just keep coming. Take your investable cash and invest in an asset allocation strategy that makes sense for your financial situation. Consider the following when determining your risk profile. Are there other sources of reliable recurrent income that give you the liberty to be a tad more aggressive in your investment strategy? Are you receiving Social Security benefits or pension income? If you are, this income might offset the need for more income producing bond funds. Less bond funds means that you can put more towards stock funds, which increase risk but also can enhance rewards. Again, every situation is different, and I strongly suggest you consult a financial advisor to determine your time time horizon, your risk profile, and your asset allocation strategy. In our scenario, our couple receives a small pension. The couple also has elected to begin taking Social Security benefits. Knowing this, they feel comfortable allocating their investment portfolio for growth. In their case, 80% in stocks and 20% in bonds. Now, historically, an 80 to 20 asset allocation would have yielded 9.61% average growth on an annual basis between the years of 1926 and 2019, according to Vanguard Advisors. In our scenario, we're going to be a tad bit more conservative and use an anticipated 8% average annualized rate of return. Step 15, determine your annual spending allowance from your portfolio. Now, keep in mind, when I say spending allowance, I only mean the allowable distribution from the portfolio composed of home equity monies. This is not an allowance made up of all other sources, because again, the idea is to show you how to convert the equity that was once locked up in your home's value into an income producing portfolio. Okay, so now is a great time to introduce the 4% safe withdrawal or 4% safe spending rule. Essentially, take the balance of the assets in your investable brokerage account and multiply it by 0.04. This is equal to 4% of your portfolio's value. This is the amount you would ideally spend from your portfolio on an annual basis. The benefits of the 4% safe withdrawal strategy include lifetime income that inflates year after year to keep up with inflation. The strategy also preserves the principal amount invested. So if you started with $1 million portfolio, the portfolio will maintain the principal value so long as you never take a distribution of more than 4% of the portfolio year over year. You have to remain invested in a broadly diversified stock and bond portfolio and make sure that you have exposure to at least 80% of stocks in this specific example. So to give you an example, a $1 million investment portfolio should yield an annual gain of 8%, $80,000. Imagine that you give yourself half of that 8%, so 4%. So that's $40,000 of gross income annually you get to spend on your living expenses. The remaining 4% goes towards inflation so that your next annual distribution is now $41,600. If you hire a financial advisor to manage your portfolio, on average, they'll charge about 1% of the value of the portfolio for investment management and advisory fees. Okay, so let's imagine you have a couple in San Francisco. They're both 67 and they both have just retired. They've decided that given the history of health issues in their family, they determined that for them, taking Social Security at 67 is what makes sense. There is a small pension of $1,000 a month, and the couple has retirement assets of about $1.5 million that they have not touched and don't intend on tapping into for a time. The couple estimates it costs them about $9,000 a month to maintain their standard of living. They bought their home in 2000 for $750,000, and they plan on selling this year as they're now ready to leave the Bay Area for a life of leisure in sunny Palm Springs, California. The home has an estimated fair market value of $2.2 million, and the couple has a first mortgage on the property of $200,000. That means they still owe $200,000 on their mortgage. In addition, the couple took out a second mortgage to pay for a $100,000 seismic retrofit. They spent money to improve the foundation. Our sellers will pay a 6% commission to the realtor, so that comes out to $132,000 in commissions to the realtor. The IRS allows married couples who file jointly to exclude up to $500,000 in capital gains from their capital gains tax calculation. Now, I originally told you that it was going to be 12 steps, but it ended up being 15 steps. And like I said, this is a huge transaction, and of course it's going to have a lot of steps. And a lot of the steps are going to be performed by the professionals that you hire. So your certified financial planner, your CPA, and your realtor, to name a few. But they should all know what we're trying to achieve, and having like a ringleader who can see like the big picture is really important. And in some cases, that's going to be your financial planner who's going to be kind of project managing the entire process. I'm just going to run through a few of the calculations. I think it's going to be a little bit easier if I show you. So one of the things we're going to need to do is first find out what the basis is. Now, if you remember, basis is the value of the home when it was originally purchased plus any improvements to the structure of the property. That increases the basis amount, which reduces the amount of capital gains taxes that you'll need to pay. So this specific client, or our hypothetical client, again, bought the house in 2000 for $750,000. And like I told you, they did the seismic retrofit of $100,000. I don't think I told you about the $50,000. Maybe I did, but let's just say that the $50,000 was used to, I don't know, maybe they had a bathroom that was just not completely renovated. So they did that and they put in some new floors somewhere, whatever. $50,000 gets it to a place where they can sell the home. So that means that the net adjusted basis, or the total amount that you can use for basis in the calculation, is going to be $900,000. Okay, so next part is that I talked about in San Francisco, we have this really funky thing called a transfer tax, and it's based on the sale price. Now, I told you earlier that we're gonna just go with the best estimate. We're gonna do that here too, just so we can have an idea of what to expect. So like I said before, for a house that sells in this range, for a $2.2 million home, I think that they pay $3.75 for every $500,000 of the sale, which when you do the math is 0.0075. So that means that transfer tax is going to be $16,500. Okay. I told you that the realtor is going to charge 6%, so that's $132,000. All of these numbers are going to be important because we're going to include that in our calculation. You get to subtract all of these things that I just mentioned from the calculation. So it's important to keep track of them. Okay, staging fees. Like I said, the realtor, high-end realtor I spoke with said that you can expect to spend about this much, $12,000 or so, for staging at a house that's worth $2.2 million in San Francisco. Okay, our couple has annual household income of $150,000. That's gonna be important later because we're gonna need to know that to calculate our capital gains tax rate. The capital gains calculation, I'm gonna run through these numbers. We have a final sales price of $2.2 million. There is a realtor commission of $132,000, staging fees of $12,000. The basis of the home is $900,000, and the section 121 exclusion is $500,000. Remember, the federal government and the state of California say that if you meet these specific requirements and you're a married couple, you can knock off $500,000 in capital gain. It's like a freebie. You don't have to pay taxes on that so long as you meet those requirements. So $500,000 of the profit is not included in the capital gains tax calculation, so we get to exclude it there. So that means what's left is $656,000, which is going to be subject to the capital gains tax rate. This couple is going to be pushed into the 20% capital gains tax rate for long-term gains. And on top of that, this gain for this specific year, it's going to push them into something that's called the net investment income tax, which is going to be 3.8%. So I should probably add that. Oh wait, no, it's already here. There it is. So capital gains tax rate, we'll do this plus NIIT, just so we have it there. So that means come next April, when it comes time to pay taxes, they're gonna need to have about $156,000. You gonna come up here? Up? Okay. All right. Are you gonna help with the video? Yeah? Okay. So we kind of run through a similar thing, and we do it in California this time. And I told you that in California, there's no distinction between capital gains rates and income tax rates. So yeah, it's boring, huh? I know. I'm teaching them. Okay, so this specific couple, so our couple earns $150,000, and they are, this gives me an idea. If the couple can wait to sell the house in a year when they are retired, then potentially their household income will be a lot less that year. But let's say they don't do that, and let's say they just sell now while they're still needing. Okay, so all right, so do you want to go down? Bye. Okay, California capital gains, it's a little bit trickier. But you basically take that same number, that 656 that we got from up here, because we can use it down here. This is the total? This is the total taxable amount, and you're gonna take their income and you're gonna add it together, and then you're gonna look at the California tax bracket table, and it's gonna say that they get pushed into the 11.3% tax bracket at income of $806,000 that year. So that means that in April, they're gonna pay $74,000 in capital gains taxes to California. Okie dokie. I told you that the couple has a mortgage. They had a mortgage of $200,000, and on top of that, remember they took out $100,000 for the seismic retrofit to pay off their mortgage to the bank, both mortgages. So that's $300,000. Okay, so now let's go back to, let's find out how much money's left over after everybody gets paid. Okay, so you have your final home sales, again, is 2.2 million. 300,000 goes to the bank to pay off the mortgage. $156,000 goes to the federal government. $74,000 goes to California. $132,000 goes to your realtor. $16,500 goes to San Francisco transfer tax. And then the net asset available for investing is about $1.5 million. But they're not going to invest all 1.5, right? They have to buy a house in Palm Springs. So from the 1.5, they're going to subtract $750,000, and that leaves them with $771,000 that will be deposited into their brokerage account, which will then be allocated appropriately in a portfolio that will produce income for them. How much income, you ask? I'm so happy you asked. The safe withdrawal, let me correct this, safe withdrawal, safe spending allowance. So you take that remaining amount after they've paid everybody and bought a new house in Palm Springs. They now have $771,000 left. If you multiply that by 4%, you're gonna get an annual budget for spending, $30,000 a year. And if you divide that by 12, you'll get a monthly number. So that means they were able to sell their home in San Francisco, pay all the taxes, and they're gonna have a house in Palm Springs that's completely paid off, right? Walk away with $771,000, which is gonna turn into $2,500 in monthly income. Do you remember I told you that the couple had $1.5 million in their retirement portfolio? They decided they're not going to take any income from that. But if they wanted to, we would just do the same calculation, right? So you just do that 4% equals $1 million. 5 times 460 divided by 12. So, I mean, that's another 500. I'm sorry, 500? So that's another $5,000 a month if they needed it. I don't think they're gonna need it, so we didn't include it in their income calculation. They both had careers, and so they're going to take Social Security income, and there is a small pension of $5,000. Wow. They're gonna take Social Security income of, what happened here? Okay, so going back to our example here, Social Security is gonna be $500,000 a month, and then their pension is $1,000 a month. Okay, so I think earlier I said something like the couple needs like $9,000 a month to meet their living expenses. They're pretty close. I would then maybe consider, you know what, actually, I would not suggest taking some money from this portfolio because chances are they have less overhead running their home in Palm Springs. Remember, they moved into a condo community. Maybe they'll have an HOA, and maybe they'll have a land lease, but yeah, maybe they can knock $6,000 off of their annual spending, which I think they should be able to do because of less overhead. So I ran through so much in that short amount of time, and there are a lot of moving pieces in this kind of transaction. But from start to finish, that's how you convert equity that's trapped into a home into lifetime income. If you have any questions on how to do this, just drop them in the section below. If you want specific advice to your situation, then drop me an email. There is a link below that you'll click, and we'll schedule a time and we can talk about it. But it's not magic, it's just a lot of steps. Thank you so much for watching. Again, if you found this valuable, I'd love it if you subscribed and you hit the notification button so you'll know when there are new videos. Also, I wish you prosperity in all things today and every day. I'll see you later.